Now let's take a look at the bigger picture. Octavio Marenzi is with us, CEO at Optimos. Good afternoon. How are you feeling about the market today?
I don't know if I have a particular feeling about the market today. I think I would echo what your previous panelists just said in terms of what's likely to happen with the Fed and what's happening with inflation. I think we're moving more and more in the direction that the Fed is actually going to have to increase interest rates. I know I've said this to you many times before, but I think that's the likely outcome that we're going to see over the course of the next couple of months, is not that the Fed is going to cut interest rates this year, but actually towards the end of the year, they might well actually hike them a bit, I think. So we're going to continue to see inflationary pressures. Markets are doing really well. That's going to encourage the Fed to increase rates. And the economy has held up much better than they thought, and unemployment is still very low. So all the indicators are pointing towards the Fed actually increasing rates rather than decreasing them.
Right, understood. I mean, look, we got in GDP. You haven't seen tons of strength. I mean, slower growth as far as labor market looks like it's maybe slowing a little too. Would you agree with that? I mean, when you think about what could be slowing, at least a little.
A little bit. And the economy, yes, we've seen the latest numbers for GDP come in for the past quarter, maybe a bit down as well. But I think all these things are going to look at the Fed. But I think the way the markets are going up and up, the Fed is going to take sort of solace and say, well, we can afford to increase rates a bit. So I think they're just going to wait for a while. They don't want to shift the narrative too quickly and shock the market. But I think we're going to hear from them more and more that we have to be careful with inflation. Inflationary pressures are still there. And I expect them to gradually to move more and more that direction over the course of the next few months, and then basically pop sort of a surprise interest rate hike on us sometime in the latter part of this year or early next year.
Right. Look, when we talk about the Fed, and then I'm thinking about Bank of Montreal, and you're following that, give us an update on that.
Well, Bank of Montreal had a very, very bad day yesterday, so its stock was down almost 10%, and that's very unusual for such a large cap stock to have such a swing in a single day. I mean, I know Salesforce had even worse day today, but that's unusual for a banking stock to move that much in one day. And basically, the story was that Bank of Montreal had shown some weakness in its retail lending activities. They'd increased their provisions for loan losses, and I think that was the major factor more than anything else. Plus, they'd seen a bit of a decrease in sort of the net interest margin that they earn, or pressure on that side. So those things added up to not a terrible miss on the earnings. And bear in mind, the provisions that a bank sets aside for losses are just forecasts. They're not actual losses. So basically, the banks have to say, what do we expect our losses to be in the coming 6 months? And we'll put that much money aside to cover those. So it's an estimate that they've made, and sometimes those estimates are wrong and they have to unwind it, and then profits jump back up.
Right, and look, yeah, sometimes they don't use it, and then people are happy that, look, they're not seeing the loan losses that they anticipated, to your point. When you think about the large U.S. banks, how do you feel about our big banks here at home?
Listen, they've done fantastically well over the course of the past 6 months, over the past year. Basically, all the big five over the course of the past half year have handily outperformed the S&P 500. I think S&P 500 is up like 15% past half year. All the big banks are up at least almost twice that much. So, and the best performers are people like Citibank and JP Morgan, getting close to 35 or 40% return even over the course of the past 6 months. So big banks are doing very, very well indeed. And I would expect that to continue. They seem to have a bit of a slowdown in terms of the net interest margin, but nothing spectacular. They're still sitting on lots of deposits that they built up in COVID, basically, that they haven't got around to lending out yet. So they've still got quite large excess reserves that they still have capacity to increase their lending. Their default rates on the loans are at historic lows in most lines of business. Credit cards are inching up a tiny bit for the big banks anyway, but for the rest of the loan portfolios, commercial lending, even commercial real estate looks pretty safe and stable. So all those are good indicators. And we're seeing investment banking and capital markets starting to pick up some of the lost ground they've had over the past couple of years. So that's really favoring the very large banks in the US.
Yeah, when I saw investment banking come back in your notes, it stood out to me. It's a good feeling to see it, right? I mean, what does it say to you?
Well, there's more deal activity. There's more confidence in the market. There's more M&A activity. There's a bit of an uptick around the world in terms of IPOs. So all those things are increasing. And I guess for some time people thought, well, this is a bad time to go public and take my company public. But now, the stock market looks great. Of course, there's a bit of a lead time in going public. So you have to really start to think about it about a year ahead of time and start to put everything into place. And a year ago, the markets didn't look so favorable. So that led a lot of companies say, okay, we're going to wait for a while till the markets are better. But now we're starting to see a pipeline of that build up. So we need to see high markets for some extended period of time before all these companies want to go public again and raise money in the public markets. And that's what we're starting to see. We're in the early phases of that. But I think that's a movement that has got legs. So the big investment banking names, I think, should do quite well out of that in the course of the next 12 to 18 months.
You're not touching the regional banks? Not interested?
Listen, regional banks, it's a tale of woe. They've done really badly. They continue to do really badly. I mean, I was just looking at the S&P Regional Banking Index. If you look at that, over the course of the past 5 years, if you'd invested in that index 5 years ago, you would be down now. You'd be down like 5 or 6%. So that's
Right.
miserable. That's absolutely miserable. But I think what we're
Right.
seeing I mean, that's just the past 5 years have been so great on the markets. To be down is just absolutely catastrophic. But I think what we're seeing there is that a slightly different side of the story that we see for the big banks. So their default rates are going up quite rapidly. So especially on their credit card portfolios, they're starting to see some stresses there. So that's a big
What do
problem.
you
They're starting to
advise?
see money run out the door more quickly than the large banks are. So depositors are chasing higher interest rates. A lot of deposits are very, very sticky and stay for a long time. But at the regional banks, they tend to move the money out more quickly. So especially sort of the institutional depositors, they sort of the wholesale clients will move their money very quickly. So we're seeing that pressure. So there's a
Octavio.
net interest margin
Yeah.
pressure. There's a pressure on their lending activities in terms of default rates. There's other pressures there as well. They tend to have
Octavio, I
much
have a
larger
question.
exposures to the treasury bonds that they bought over the course of the past few years, which have come down with increasing interest rates. So they're very exposed there. And we know that the Fed is less likely to bail them out and much more likely, in case of sort of stresses,
Octavio.
come in and sort of hand the whole ship to a larger bank who will benefit from them.
Octavio.
So I think we're going to see
I just
some
want to be able to
turmoil
jump in
the
here.
regional banking sector in the next 12 months. And the big banks will be the beneficiaries of that. They'll be able to pick these things up at a very low price and expand their market share, increase their deposit bases and their customer bases by buying these defunct small regional banks. I think that's a trend that's going to continue as well.
Listen, Octavio Marenzi of Oppenloss. Thank you.